Josh, an asset class that we've been speaking a lot about on the investment committee is fixed income. It is an interesting asset class in today's market environment. And we look over the last 5 years, and it has been an asset class that has not provided returns that most would be all that happy with, in the sense that we've seen some very challenging market environments. Specifically, what comes to mind is 2022, one of the worst years we saw for fixed income. And even last year, we saw a pickup in fixed income, but we're still kind of coming over those losses that we've seen since COVID. So I think now is a perfect time to ask, probably a simple question, but why do we own fixed income at all?
Absolutely. And this has come up in quite a few client conversations as well. With stocks doing as well as they have, bonds have felt like something that has been holding back performance. But we really have to look longer term into the use of fixed income and how it has really contributed to portfolios. It's really acted as that ballast. So you think about difficult times in 2008, a little bit in 2011, and even during COVID, those areas of the market have not gone down as aggressively as stocks have gone down. As well, it's been a great source of income for clients that are in distribution mode. So we really have to go back to where it was pre-2022 and how it operated in the market.
That historical perspective is important, right? We always want to think about what history can teach us. But let's talk a little bit about now, right? What is the current interest rate environment? What does that mean for future returns?
Absolutely. So when we think about holding bonds today, what we really need to look at is the expectation of interest rates over time. So we're going to pull up a graphic here that's going to show where the Fed funds rate or short-term interest rates have been over time. And what you'll see is a few dot points that show where expectations are for where interest rates are going to go in the future. And what this shows is that interest rates are expected to come down. The question here, and I'll be frank, in 2023, if we looked at this chart, it was very similar, and it has been delayed and delayed and delayed, and interest rates have actually creeped up. But where we are today, the expectation is rates do come down. It's a question of when. The second graphic we're going to pull up is really how different bond categories react to falling and rising interest rates. We're going to highlight a few of the different categories that we hold in target portfolios. And what we're showing here is that you have a generous potential upside if rates come down, and actually fairly limited risk on the downside if rates continue to go up, which is something we look at. So very attractive from that side. The last instance I will bring up is just that if rates do not move, if they stay the same, we are at extremely attractive levels in terms of yield and income versus what we have seen over the last 10 years.
I think many people would say bonds aren't all that exciting, but we would say they are quite exciting in today's environment. I'm not sure if that says more about us or about bonds, but I will say with attractive interest rates, the ability to be a diversifier, we believe a lot in that asset class.